So I'm, on my real estate investments, I can be making money three different ways. I got my cash on cash return. I've got my appreciation of the property, and I've got the equity pay down from my tenant, basically paying my mortgage. So those things combined make real estate a far more effective vehicle for building wealth.
Welcome to Real Estate Deal Closers with Anette, Talie, where we focus on the deals. Our guests are real estate closers who will share in detail the whole process from finding a deal to closing it, as well as strategies and tips to help you do the same. Here's your host, Anette, Talie.
Welcome to another episode of Real Estate Deal Closers. I am your host, Anette, Talie, and my guest today is Ted Lanzaro. Welcome, Ted.
Thank you, Annette. Thank you for having me here today. That's great.
Super excited to have you on the show. But before we start, I want to tell you a little bit about Ted. He is a certified public accountant, real estate investor, real estate broker, author, and speaker with over 29 years of real estate tax consulting and investing experience. He runs Lanzaro CPA LLC, a boutique CPA firm specializing in accounting and taxation for real estate industry. For the past 29 years, he has helped thousands of real estate business owners, entrepreneurs, and investors all over the United States implement cutting-edge tax strategies that save them thousands of dollars annually on taxes. So, Ted, tell me, how did you get into real estate?
Yeah, no, you know what? It's and thank you for that. And you know what? It's funny because it's 30 years now because I just finished my 30th tax season.
Oh, wow. Congrats.
Earlier this week. Yeah, right. So I got into real estate back. It was actually in South Florida, and I used to live in the Boca Raton, Delray Beach area, and I was working for a local regional CPA firm in Boca Raton, and a friend of mine, I went to high school down there, and a friend of mine from high school approached me, and he's like, "You got to read this book." He said, I said, "Well, what book is it?" He's Rich Dad, Poor Dad. So he gave me a copy of the book. And I had been I worked in the real estate department of this CPA firm. So I dealt with, developers and brokers and investors already, but I was doing their taxes essentially. And I'd never actually been an investor myself. And I said, "Well, I said, my clients are making a ton of money." I said, "I think you're right. Let me read this book." Right. So I read the book. And I told my friend, "Okay, let's go out and check some things out and see what kind of deals we can find." And the first day we went out looking for houses in Fort Lauderdale. We bought actually that day we put offers on 3 houses and bought 3 single family houses down in the South Florida, right off of Oakland Park Boulevard.
Wow.
At the time, these were like little 3-bedroom, 3-bedroom, 2-bath houses. You could buy them like about $85,000. They rented out about $1,200-1,300 a month or whatever. And as a result of that, I started a portfolio, and I started going to real estate investment club meetings, locally in and around the area. And some people found out that I was a CPA and that I was, building a real estate portfolio. And I said, "Well, you must know all the tax tricks." And I said, "Well, I'm using a lot of them for myself and a lot of them for my clients. Would you do a presentation for our group?" And I had never done a presentation before. I wasn't sure how. And so the first time I ever did it, I just, threw together a PowerPoint and literally sat there and read off the slides in front of a group of investors at a meeting up in Port St. Lucie, Florida. And, my knees were, shaking, and, I was nervous, but somehow I got through it. And at the end, everybody clapped and, wanted to talk to me. And I ended up with a few new clients. And I've been doing that ever since. I kind of combined. I said, "Well, there must be something here." So I combined my investment experience and my tax knowledge. And pretty soon I was talking all over the place about, what I was doing and building a portfolio. We ended up buying the number of like garden apartment complexes down there and some more single family houses. And then we started buying and flipping houses, right? So I learned that process, and so that was kind of interesting because I had no idea how to do it, and the worker guys used to send me to Home Depot, right? So they would they were like, "Oh, Ted, we need more paint. Go get it for us," and I'd leave work, and go get them paint and bring it to them and whatever. So, but this could show you how inexperienced I was at the time, right? You know, so I would never do any of that now. But that's literally how I got started, and I ended up building my. We ended up taking in another partner, and we built a pretty nice real estate portfolio. That was about 2002, 2003. I ended up selling that portfolio to my partners in 2006 when I moved up here to Connecticut. And then when I got up here, I started rebuilding a new Connecticut portfolio. So it's been a blast, And now I really don't actively manage anything. I'm just too busy. So I do a lot of passive investments.
Wow, and that book has changed so many lives. I think that was also one of the first books that I read, about real estate, that an introduction to passive income and to actively investing and to not be an employee and, be a business owner instead, and, the quadrants. So it's such an amazing book, Rich Dad Poor Dad. If you haven't read it yet, you gotta get it. And, it's not really a book that really teaches you about investing in like techniques or how to do it. It's just like a mindset book that really makes you think about the way that you are behaving, and where you're going to be if you don't change that. So it's really, really cool book.
Real Estate Deal Closers, Special Edition.
All right. So, I think your experience is an excellent segue to talk about the advantages of investing in real estate, and comparing them versus other investing strategies, because I think real estate has a lot of advantages that I don't think investors realize if they are just investing in stocks or other vehicles. They are not realizing all the advantages of real estate. So, tell us a little bit about that.
Yeah. So look, I'm really kind of a stone cold real estate investor, and I do it for a number of different reasons. I think the first biggest one is depreciation and the concept of tax-free cash flow. So the whole reason somebody would want to invest in real estate, right, buy a rental property, is because after you collect all the rents and pay all the bills, you hopefully have money left over, right? If you've done this right, you have money left over, right? And but that money that income can be offset by the depreciation on the house or the property. And the depreciation on the property is basically an allocation of the purchase price of the property over a period of years that the IRS basically dictates. So for residential property, a typical residential property is depreciated over 27 and a half years, and a commercial property like an office building or a storage unit or a shopping center is 39 years. What that means is, and this is a very basic explanation, is that if I go out and buy a $275,000 house, and I depreciate it over 27 and a half years, I get a $10,000 a year, 275 divided by 27.5, $10,000 a year depreciation deduction. So I could have $10,000 of cash flow from the property minus the $10,000 depreciation deduction. I have zero net taxable income, but I still have $10,000 in the bank, right? So that's the whole idea, whether you're investing actively like I was, or investing passively like what I do now, you get the money, but it's not subject to tax because you've offset it with the depreciation. So that's probably the primary reason you want to invest in real estate. Okay. The other reason, the thing that I love about investing in real estate also is, which is so unlike the stock market, is you can use leverage, right? So if I have $10,000 to invest and I go into the stock market, I can buy $10,000 worth of stock, pretty much, right? And so nobody's going to let me buy $100,000 worth of stock and loan me the other $90,000, right? So if I have $10,000, I can buy $10,000 worth of stock. A lot of investors, if you want to buy real estate, a $10,000 down payment might get you a $100,000 house, right? That you can invest. Um, and let's say you get $1,000 a month in rent, just as an example, right? Well, now once you pay the mortgage, whatever, let's say you've got um, $200 a month left over. Now you've got $2,400 a year, or $2,400 a year left over at the end of the year. I put in 10,000. So now my cash on cash return is 24%. Um, 2,400 divided by the $10,000. Why? Because I'm using leverage, right? And I'm also, that's just the cash on cash return. I'm also, my tenant is paying down the mortgage, so I'm building equity every year, right? And the market could be appreciating. So like right now, we've been in a rapidly appreciating market for quite a number of years. So I'm, on my real estate investments, I can be making money three different ways. I got my cash on cash return, I've got my appreciation of the property, and I've got the equity pay down from my tenant, basically paying my mortgage. So those things combined make real estate a far more effective vehicle for building wealth than investing, just taking your $10,000 and putting it in the stock market with the idea that you're going to typically earn about, if you're lucky and the market stays pretty good, you're typically going to make 7 or 8% on an annual basis over a long period of time, averaged out. You can have good years and bad years, but averaged out. So which means, it takes you a long time to build wealth in the stock market versus being able to do it with rental properties.
Yeah, that's awesome. And even if your property doesn't appreciate, but if you work the numbers properly, you're still gonna be making cash flow. So it's not like on the market where it just goes up and down and you have no control of it. On real estate, if you bought it with the right numbers, you're still gonna cash flow even if the value of the property goes down. You still can be making money with the cash flow.
No, that's true. Yeah, exactly. And look, and I never would tell anybody to buy a property with the idea that it's going to gain in value. You always want to buy based on the cash flow, right? So you want to make sure that when it's done, you've got money left over, because and this is a real story. I was telling you about those houses that we started with in Fort Lauderdale, right? So you're familiar in Florida, you have a homestead law, right? Okay.
Yes.
And your real estate taxes can only go up a certain amount if it's your primary residence. But if it's not your primary residence, then when the towns reassess the taxes, your taxes can go up pretty dramatically. So those $80,000 houses that we bought in 2002, by 2006, were $200,000 houses. Okay. And the city of Fort Lauderdale came in and reassessed them. And our real estate taxes tripled. Okay.
Wow.
And all of a sudden, we didn't have any cash flow anymore. We had negative cash flow, right? So they used to call that getting eaten by alligators. Right? I don't know if you're familiar with that expression, but it basically means, the alligator's taking a bite out of your bank account every month instead of money going in. So fortunately, what ended up happening was at about the same time, mortgages were so easy to get back then, right? So we ended up, as the tenants left, we ended up selling them. So we did really well because, we had big capital gains on each one we sold, and we eventually got out of that single family house situation where we had basically negative cash flow on about, 12 houses. And that's the other thing, because we had bought them all in the same neighborhood because it was easy to manage, right? But when they went up, they all went up. So there's some lessons to be learned there, right?
Yeah, I also had one of my properties. The same happened. Like I was calculating I knew that the taxes would go up, but I just based my calculation on how much it would go up based on other properties that I own around.
Mhm.
But this property just went up super high. So I thank God in the area that I invest, the property appraiser has an estimator. And so I use the worst case scenario because I don't want to be in that position, because it didn't go negative on my property, but it was just breaking even and it wasn't making any money until I was able to refinance. And now it's making money again. But yeah, if you don't do the numbers properly, then you can either break even or start losing money. So super important. Um, all right. So, we have depreciation, we have leverage and appreciation in real estate. Um, but how is this different or for active versus passive investors?
Right. So now we're talking about actual tax consequences and the ability to deduct rental losses. Because typically, in the example that I used before, we were talking about, oh, I have some cash flow, but my depreciation's offsetting it. Now it's at zero. That's typically not what happens. Typically, at least in the first 5 years of ownership of the property, your depreciation is actually going to create net losses on the property. And there's some depreciation tricks, like making sure that you segregate out certain assets within the building to get better depreciation methodology on them. But you're typically going to end up with net losses on your rental properties in the first 5 to 7 years, give or take, right? So now, can I? So now, can I take those net losses against my earned income and reduce my taxes? So what the IRS says is, if I'm an active investor, okay, an active investor means I'm basically, they're my properties. I'm managing them. I'm putting in 500 hours a year in oversight of my properties, and I make less than $150,000 a year of earned income. I'm eligible to take up to $25,000 a year of rental losses against my ordinary income. If I make under $100,000 a year, I can take the whole 25,000. So let's say I make $100,000 a year and I've got $25,000 in rental losses for my rental properties. Well, now I only have to pay tax on $75,000, right? So in a 20% bracket, that's a $5,000 tax savings. Right? That means I
Wow.
pay literally 5,000 tax. Now you guys are fortunate in Florida that you don't have state income tax. Here in Connecticut, we've got a 5% state income tax, so it's not 20%, it's 25%, right? So in that scenario, that $25,000 loss is actually worth 6,000 and change, even more, because because it's got more tax benefit.
Right.
So that's really one of the primary benefits is I'm able to take. Now, as my income approaches $150,000 a year, my earned income, I lose $500 of that ability to take rental losses for every $1,000 I earn. So if I make $101,000 a year, I can only deduct 24,500 of rental losses off that, right? And once I get to 150, my $25,000 of available rental losses has disappeared. It doesn't, you still carry it over and you can take it in the following years. You just don't get the deduction in the current year. But here's a neat trick. Think about this, right? So I make $150,000 a year. So I can't deduct any of my $25,000 of rental losses as an active investor. So, and people call me about this all the time. I say, well, are you making your 401k contribution? And they say, no. I'm like, well, do it. Use the cash flow from the rental property to make your 401k contribution. So let's say you make $150,000 a year, you haven't funded your 401k, so you put $20,000 away in your 401k. And I'm using round numbers. It's actually, I think this year was 19.5. Well, let's use 20 just for example. So now my net income is $130,000. Now I can take $10,000 of rental losses also. So I actually got a double hit on my taxes. I'm saving money by deferring part of my salary. And by deferring part of my salary, I'm also eligible to take a rental loss. So that putting that $20,000 away actually saves me $30,000. Does that make sense?
Yeah. Absolutely.
right?
Wow.
Exactly. So, and then if now let's say I don't work for a company that I can put that I work for myself, I'm self-employed, and if I make $150,000 of self-employment earnings, right? Well, I can do an even bigger contribution. Maybe I can put away 20% of that or more. Let's say I put away $30,000. I use a SEP to put away $30,000 in retirement. Now I get that $30,000 and $15,000 of eligible rental losses. So that $30,000 retirement plan contribution saved me $45,000 in taxes. So, being creative, and that's where tax planning comes in, right? Because that's where calling your accountant and saying, how do I deduct my taxes? Not, a lot of accountants will say, well, you make $150,000 a year, you can't deduct any of your rental losses. Nonsense. How can I deduct my rental losses? Right? That's one of the ways by reducing, using the deferrals to reduce your income so that you're eligible to take more rental losses. Right? Now, if I'm a passive investor, meaning I've invested in somebody else's deal, or my income's way over $150,000 a year, so I'm never getting down below it anyway, right?
Mm-hmm.
So effectively, but if I actively manage my properties, if I'm making $500,000 a year, I'm basically a passive investor, right? So as a passive investor, the IRS says you cannot deduct rental losses against your ordinary income, right? What happens is those rental losses carry over until one of a few things happens. The first thing is I have net rental income somewhere, right? So I may not be able to deduct losses for 5 years, and then all of a sudden my property starts having net rental income. Well, I'm going to use all those past carryovers to offset my net rental income until those losses are gone. So even a passive investor may not end up paying end up paying taxes on his cash flow for 10 or 12 years because they're going to use the carryover. They're going to get to zero every year,
Right.
net loss, net income or loss, and they're still going to have some X left over, and that leftover is going to cover their taxes in year 6, 7, 8, 9, 10, until it's used up, right? The other way that you can use passive losses is when you sell the property. So the IRS says when you sell the property, any carryovers you have can be immediately taken. And most of the time, what ends up happening is they help offset the gain on the sale of the property. So it's a really good strategy, right? So for passive investors, there's nothing. And here's the other thing about passive investors, right? Passive investors will say to me, "Well, um, I can't deduct the depreciation, so I don't want to invest passively." But they're missing the point. When the point is that you're getting tax-free cash flow, right? So if I'm a passive investor and I make $200,000 a year, and I'm paying 20% taxes, I'm paying $40,000 in taxes, right? On my
Mm-hmm.
$200,000 at 20%.
Right.
Well, if I use that money to go out and build a passive portfolio, and that passive portfolio, after a couple of years of investing, maybe I have an additional $50,000 of cash flow coming in that I'm not paying taxes on, right? So now my real cash income is 250,000. 200 that I'm earning from my job or my business plus 50 I'm earning passively. I'm still paying $40,000 in taxes. So my marginal rate is not 20% anymore. It's actually probably like 15% or 16%,
Mm.
right? So by building a stream of passive income, I'm putting more money in my bank account, but I'm not paying any more in taxes. And the more money you make and the more money you invest as a passive investor, the more tax-free cash flow you can build, the better off you are. So I have clients that make $1 million a year. They can't deduct any passive losses, but they have a ton of money to put away in passive investment. I have this one guy. He put away enough money that he generates literally about $500,000 more a year in passive income that he doesn't pay any taxes on. That cuts his marginal tax rate by a third. Because now
Okay, so
instead of having
let
a
me see if
million,
I understand this. So if you are like, if you invest passively, you're gonna generate passive income, right? So now, um, but you cannot use your depreciation, you said, correct?
Well, yes, you're gonna get passive cash flow, and you can only use the depreciation to the point where it gets you to zero.
Mm-hmm.
You can't take a loss. So if I've got $100,000 of passive income, I'm probably paying zero taxes on that,
Oh, wow.
right? Right?
Mm-hmm.
Yeah, but I still have the money in the bank, right? So if I make, so take that, extrapolate that out. If I make $1 million a year at my business, okay,
Mm-hmm.
and then I have another five, and I pay, and then let's pay, I say, pay $400,000 in taxes on that $1 million. I'm in the 40% bracket.
Okay.
Well, now if I add $500,000 of passive cash flow that I'm not paying taxes on, I'm I now have $1.5 million running into my bank account every year, but I'm still only paying $400,000 in taxes because I'm not paying taxes on that $500,000. So what has happened? My effective rate is going down. If
Right.
I'm not in the 40% bracket anymore. I'm in the 28 or 29% bracket. I mean, it's an extreme example, but I have somebody who's done that. Right?
Wow.
You know, they had to put away $5 million in order to do it, but they did it. Right?
Right. So
So
it definitely pays to diversify and do some active and some passive.
yeah, yeah, I think so. Yeah, I think so. And then so let's go to the third alternative, which is real estate professional, right?
Mm-hmm.
So let's say this guy who's got $1 million, $1 million a year salary, right? Let's say he has a spouse who's interested in real estate, right? And that spouse says, okay, well, you know what? Let's go buy some active properties. I'm going to manage them. And by managing them, I'm going to get my 750 hours that is mandated by the IRS as the qualifier for real estate. And since I don't do anything else, I meet the other criteria, which is it has to be at least 50% of everything I do. So there's two criteria: 750 minimum hours in real estate related activities, running a real estate related business, which property management counts,
Mm-hmm.
right? And it has to be more than half of what I do. So yes, it is. It's more than half of what I do because it's all I do. So it's 100% of what I do. So now I
Right.
qualify. Now I can take losses against my spouse's $1 million worth of income. So let's say I have that same $500,000 of cash flow, but my K1s actually show a $300,000 loss, which is entirely possible, by the way. Well, now being a real estate professional, I can offset that 300 against my spouse's $1 million salary and only pay tax on 700,000.
Wow.
So that's the beauty of real estate professional status. It has to be done right, and it has to be planned out correctly. Okay, and you need to be running a business that you make money at. Okay, at least that's not an IRS criteria, but that's a criteria for me to make sure I'm protecting my clients. I want you to be running a business that you're actually making some money at, right? So that if the IRS calls you into their office, you can say, well, look, I'm a property manager. This is how much money I made as a property manager, or I'm a real estate broker, or I'm a developer, right? I have clients that are flippers, they're developers essentially, and they own rental properties. They're real estate professionals. They qualify.
Yeah.
So
Absolutely.
that's the holy grail of real estate investing is being a professional because it basically allows you to take unlimited rental losses against your ordinary income on an annual basis.
Wow. Unlimited. So you gotta to be a real estate professional, you gotta do 750 hours of real estate activities, and it has to be at least 50% of what you do. So if you have a full-time job, you're not going to qualify because it's not 50%, unless, I mean, I don't know how many hours, like unless you work for 1,500 hours a year.
Yeah, you could think about this. The average 40-hour a week person works 2,080 hours a year, right? So you'd have to have 2,081 real estate hours. That would be insane. You wouldn't have a life,
Yeah,
right?
exactly.
Essentially. Now,
You will have
are there
two
people
full
who
times.
right? Are there people who do it? Yeah, or are there people who claim to do it, right? So yes, there are, right? Those people have bullseyes on their back. Those are the people that the IRS call into their office and say, "Let me see your real estate log, right? I
Right.
want to see your record keeping of how you managed to do this, right? Because it's unusual to say the least. So what I advise people to do is, if you're going to try to do that, right, man, your tracking better be bulletproof, because
Right,
you're getting called in.
right.
More than likely, over some period of time, you're going to end up in the IRS's office with your real estate audit.
Right. So I was I'm gonna be claiming real estate professional for my tax years last year, and but the good thing is I work part time, so I don't work full time. But my accountant was worried about it, and I was like, "Don't worry, I'm tracking everything. This is the way I do it, and I don't know if it's the best way, but I just put everything on my calendar." On my phone calendar, and I just tag it as real estate, everything that is real estate, and I just have an hour meetings, everything, and then I download all those transactions into a Google sheet, and then I have it adds up all the hours. So far it's been working really good to track the hours. What are
Yeah,
the
no,
other
that's
ways?
well. I was just going to say, the more detailed you can be, right? Like, if I go out and look at a property, if I'm tracking my hours and I go out and look at a property, I'm taking pictures of the property. I'm filling out a sheet about the property. If I met with a broker, or an agent, I'm taking their card. I might even take their picture, right? The more detailed, if you go out to lunch with your investors or something, hey, I had lunch with Annette today. We went to, whatever restaurant at whatever location, and I'm going to maybe I'm going to clip the receipt to, my tracking sheet for that day, and I'm going to, write a little note about what we talked about, right? All the more detailed you can be, the better off you're going to be if you ever get questions. And it's kind of interesting from this standpoint, which is, um, it's if you do it right, you are going to get such a big tax, probably going to get such a big tax deduction, that it's worth doing the extra record keeping, which can be a pain, and a lot of people don't want to do it, but it's actually, there's responsibility that comes with every opportunity, and that's what it's really about.
So
So,
what type of activities qualify and what type of activities don't qualify for these 750 hours?
so if I'm operating my business, right, any of the operations of my business qualify, right? So, if I'm a real estate agent, for example, right, it's all my research, all my showings. Um, but if I go to a CE class, I can't count that, right? Education doesn't count, right?
Oh, education
So a
doesn't
lot
count.
of people, a lot of people say, oh, well, I went to an event. I spent, blankety blank. I spent the entire weekend at, Joe Schmo Guru's event, right? Well, you know what? That doesn't count, right? But you know what does count?
The
The
networking?
time, the time you, yeah, the time you spent in the hallways networking, right? If you're documenting it, right? So you can say, look, between the hours of 12 and 1, when we were on break for that weekend, I talked to the following 5 people, and I've got their cards, and I've got the note on the back of their card of what I talked about. Because what is that? That's marketing. I'm marketing my business, right?
Mm-hmm.
I'm meeting connections to buy properties. I'm doing all of those things. So all of the ordinary activities of running your business, all of those real estate, like if you're an agent, all the things that you do as an agent. And what I typically do when I teach people about this, to put together a spreadsheet, like if you're putting together your Google sheet, right? Let's say you're doing it as a landlord, right? You're using your landlording activity. Well, there's probably 10 or 15 things as a landlord you do every week,
Constantly,
right?
yes. Yes.
Constantly, right? So you list those out, automatically, and then you just pop the hours in, right? Because you're going to be chasing rents,
Right. Every first of the
or
month, you're gonna be, collecting rents, and every, 15 days, you're gonna, do some maintenance or whatever. I did that. I actually auto-populated the stuff that I know for sure that I do every month, or every week in some of the activities, and I just put it there. And then if it changes, then I just move it. But I know that it's there if it's every week, So that's awesome.
Right.
So what about, for example, for people that do capital raising? Um, would all the networking events like meetups, like attending these places or having lunch with investors, and would these activities qualify?
Yeah, I would say they do because I'm running a real estate business. I'm in the business of real estate capital raising, and I'm running a real estate related business where we're acquiring properties. Right now, what I would tell people is, for me, I'd like to see you, like when you take that real estate professional status, I'd like to see you have an acquisition fee. And I don't care if it's $5,000 or $5 million. I think you should have made some money. So if somebody comes to me and says, and I have a lot of people who do this, they, oh, we spent the whole year, basically they spent the whole year attending events and meeting people, right? And building sort of a database of potential investors, right? But they didn't buy a property, and they didn't. Now, that's a little bit tougher sell, right? If I was going to take real estate professional status, I probably still would, right? Depending on the situation, but I would be warning them that this is not as good as if I had done the exact same thing, done a deal and taken an acquisition, because that extra piece legitimizes the activity. Does that make sense?
Right. Yeah. But that would be a little bit more if you're doing syndications, right? Like, what about if you're doing joint ventures? The fact that you're just buying property, would that be suffice? Like, if you are buying
Yeah.
property?
I bought a property. I'm making rental income,
Right.
right? Even if I don't have any net at the bottom, I still have dollars. I'm still producing dollars coming in, right? So
Right.
yes, absolutely. Yeah. Instead of an acquisition fee, I've made rental income. I just want to make money. I just want to be able to show that I did something that generated someone to pay me, right? Does that
Right.
make sense? It would be rental
Absolutely.
income, brokerage income, whatever it is.
Right. And for example, people that have podcasts like me, or I know you have a YouTube channel. When you produce this content, would that be considered part of your hours, or that is not?
Yeah, I mean, look, I'm marketing my business.
Mm-hmm.
That's part of the marketing of the business. So yeah, I consider that. I would consider that, part of the marketing of the business. But that's part of the ordinary activity of my business. Even as a CPA, and I don't have to track my hours as a CPA, but I probably spend, I don't know, 5 or 6 hours a week producing, the content that I put out, right?
Mm-hmm.
And do the other activities. Some weeks there's no content, but there's me on Facebook talking with people or answering questions or whatever. All of that is marketing, and I can make direct connections from those activities directly to client acquisition, right? So you want to be able, as an investor, to make those exact same connections with your videos. Hey, Joe Schmo investor saw my video. He called me. We had lunch, right? So think about when you're attracting investors, even for your joint
Mm-hmm.
ventures. It all starts with some activity, and then there's a period where you're getting to know the person. You're showing them what you're doing. You're going to lunch. Maybe you send them emails. All that. If you're doing this right, you have some sort of database management system where you're putting and logging all of that stuff in. Even as a CPA, I have that for my business.
Right.
So I can tell you, hey, this is how we met, this is who referred you, or this is what video you called me on, or this is the question that I answered, right? And I can literally track, like, and I'll just give you an example. And as an investor, you want to be able to do this also. I can track one answer on Facebook. Somebody asked a question, I answered it. It led to a speaking engagement,
Mm-hmm.
okay, which led to about 10 clients, which led to about 15 more speaking engagements,
Mhm.
which probably um, turned into about 30 or 40 clients, right? And I can track that all the way through my system, right? Because that's because that part of my business, that's part of my business. The client acquisition or investor acquisition or deal acquisition, it's all part of the act. That's what you're doing. That's the business.
Absolutely. That's awesome. So, you know, so the best one is when you are a real estate professional, but otherwise if you don't get to those 750 hours, you can do the 500 hours and be just an active investor, correct? And get the
You
other
can, yeah,
deductions.
exactly. That's exactly right. But unless your income disqualifies you, then that's the next best choice. But I don't want to. Look, I tell people all the time. You know, uh, it does tax free cash flow is still good, right? If you can get the tax benefits, great. But don't let the fact that you're not going to get a massive tax benefit stop you from investing, because you can still build massive wealth as an investor just via the tax-free cash
Right. And we haven't even talked about, well, you briefly mentioned cost segregation, which is kind of like an extra benefit that you can depreciate more at the beginning. So can you tell us a little bit about more about what's cost segregation and how it helps investors?
flow. Right. So a cost segregation study is a study that basically breaks down the component pieces of a property into different classes, which the IRS says can be depreciated differently, right? So we mentioned earlier that a residential apartment building, for example, is depreciated over 27 and a half years. But every residential apartment has assets in it which can be depreciated over 5 years. Okay. And those assets are called tangible personal property. Okay. That's an IRS term, right? And tangible personal property is anything that I can, the layman's version of this is anything I can unplug, unscrew, somehow detach and walk out with, right? So think about an apartment, right? What are those things? The appliances, right? So the stove, the refrigerator, the sink, the cabinets, in a bathroom, the toilet, the vanity, the mirrors, shelving, all of these lighting, decorative lighting, all of these things that can be removed are considered 5-year property, right?
Mm-hmm.
Then I go outside, and there's another category called land improvements, and their land improvements can be depreciated over 15 years, right? So a land improvement would be fencing, retaining walls, the sidewalks, not the sidewalk in front of the building, but the sidewalks leading up from the parking lot to the various units. The parking lot is probably the biggest land improvement you're going to find in an apartment building, right? So what happens is, if I do a cost segregation study, and let's use $1 million building just as an example,
Mm-hmm.
the national average of 5 and 15 year property in $1 million building is about 20%, give or take, right? I've
Okay.
seen them I've seen them come out as high as 40, but on average, let's call it 20%. So I'm going to have $200,000 of 5 and 15 year property in an average $1 million apartment building. So now I'm not going to depreciate those assets over 27 and a half years. I'm going to depreciate them over 5 years or 15 years, the way the IRS says I can. What else the IRS says is, right now in 2021, all 5 and 15 year assets are subject to bonus depreciation. And bonus depreciation means I can take the entire value of those 5 and 15 year assets and depreciate them all at once in year one, right?
Wow.
So I get a massive tax benefit. So let's say so if I'm a real estate professional, I get the most benefit of it. So I have a client who is a real estate broker, and he made about $600,000 last year, 2019 actually. So, and that year he went and he bought an apartment building, $1 million apartment building, and he got like $200,000 worth of depreciation on that building, right, from doing a cost segregation study. And since he's a real estate professional, he was able to apply all of that depreciation against his income. So he made $600,000 as a broker and then deducted $200,000 of depreciation from the apartment building he bought and paid taxes on $400,000. I mean, that
It's a
right
big
there
chunk.
is yeah, it's a $60,000-$70,000 tax net tax hit, that he
Wow.
didn't have to pay. Tax savings. So about a $70,000 tax savings.
Amazing. And if he got that same amount and invested in some different asset, they would have been paying taxes on the full amount and not get this reduction on the income. That's awesome.
If I had taken the same $1 million and put it into stock, I would have no depreciation
Right. Exactly.
and I
Excellent.
would get no tax. Yeah.
Yeah. So, are there any other strategies besides the ones that we talked, or other secrets that you want to share with us that we should consider when considering investing in real estate?
Yeah, I mean, look, I wrote a whole book of them, right? I've got 39 of them in a book called the Tax Smart Landlord, which is available on my website at www.lanzarocpa.com. Um, and the important part to remember about these is that they don't apply to everyone, and they can be used in conjunction with one another or standalone. But they also have to be strategically reviewed and tailored to your situation. And that's what I tell people. There's no one size. It's not like when you go to buy a suit. There's no one size fits all. It needs to be tailored to your specific situation, and that's literally what I do all day.
Right. And,
So
and and you're so correct, because sometimes the same strategy doesn't work for you the same way that it would work for somebody else, and or there are two different options, and it's up to you which option you want to go with. So you really gotta go to your accountant and your lawyer, right? Because they gotta work together, because sometimes the accountant tells you something and then the lawyer tells you something else, and you're like, okay, which one is it? So you really need to work with them together on the strategy.
right. And think about this, just as an example. The same $1 million building, somebody who doesn't qualify as a real estate professional goes out and does a cost segregation study because they saw on Facebook that it's a good idea to do, right? They never consult their accountant or whatever. And they go out and they literally spend somewhere between $5,000 and $10,000 to get a cost segregation study done. And then they bring it to their accountant, and their accountant looks at them like, are you out of your mind? You don't qualify to take this deduction, right? So
Right.
now, right? They implemented a strategy. They did it perfectly. They did a perfect implementation of the strategy, except they don't qualify to take the deduction.
Right.
So,
So
there's a whole bunch of stuff like that has to be. So whenever somebody asks me, like when somebody says, "Would a cost segregation study help me?" I ask them about 20 questions before I say yes or no. Right? I
right.
mean, it's yeah.
Yeah, absolutely. All right. So if you guys, need to analyze this, you need to contact Ted and talk to him, but he's gonna need to know more. So you're gonna have to call him and discuss your situation so that he can give you the best advice possible.
Productivity hack.
So let's move on to one segment that I love, and this is a quick question, and this is, your productivity hack, and this is about your business. What have you done in your business that has taken you to the next level in terms of productivity? And it could be something that, like a program that you implemented, or simply a habit. I would love to know that.
Yeah, I mean, I'm sort of into that, so I probably have more than one. But the biggest one, I literally, when I sit down to work, I unplug my phone and I turn off my email,
Wow,
and I work uninterrupted,
that
right?
is so
And then I'll
important.
get on, yeah, and then I'll get on, and then I'll plug my phone back in, listen to my messages, and call people back. But I block out my time into 2 hour segments, and in my 2 hour segment, no email, no text, no nothing pinging, no phone ringing, nothing. I'm completely into what I'm doing.
I love it. Time blocking so important. To me, it's a little bit hard because I have a lot of information on my phone. So even if I do that, then I'm like, wait, I need this, and then it's on my phone. So I guess I need to find a way to not have it on my phone so that I don't have to go to it. Because I have found myself, I just gonna go get a phone number, and then I pick up the phone, and all of a sudden, half an hour later, I'm like on Facebook, and I'm like, why am I doing here? Like, why why am I? And I wasted half an hour. So I totally get it. Yeah.
Yeah, no, and you're just like everybody else. We're all the same. We're very easily distracted. So it takes a little bit of discipline. It takes a little bit of time. But on the days when I don't do it, I get far less done.
Right.
So
Absolutely.
Expert tips.
All right. So it's time now for the 3 expert tips. And Ted is going to share with us 3 expert tips on bookkeeping for investors. So, what are your 3 tips?
okay. So the first tip would be not to commingle funds. Okay. So I see investors, and look, it's very typical, especially new investors. They're pulling money from everywhere, right? So they're trying to buy a rental property, and they're drawing from their credit cards. They're drawing from their bank account, their business bank account, their mother's bank account, you know, and uh, and by the time they're done, what they have is a mess, right?
Right.
Because they didn't take all the funding sources and put into one account, and then identify each of those things by source. And that's the second tip, which is everything should run through one account per property. Okay. And
Totally
the
agree.
reason I say that is the reason I say that is if everything on my one property runs through one bank account, all the rents get collected, they get deposited into that account. All the bills get paid out of that account. If I go to Home Depot to buy something for the property, I'm using the debit card for that account. Why? So it shows up on my bank statement, right?
Hmm.
And then the worst case scenario is if I don't do any bookkeeping for the entire year, I still have all my activity on my bank statements, and I can turn them over to a bookkeeper and let them do it.
In one
Right?
place, all in one place, right? And I cannot
All
tell
of them.
you how much that helped me, because at the beginning I was doing it, everything together. So I would just like get a credit card, and it had like 12 months 0%, and I would just move everything to that credit card for 12 months, and then like move it. And then one year I didn't do the taxes like monthly, and I just did it everything at the end of the year, and trying to figure out where the expenses came from and where it belonged. That was the first year that I didn't do my taxes on time, because I've always been a person that did my taxes by March. I was done, and it was so stressful to do that. So for that year, I decided, okay, I need to separate everything. And so, like you said, I have one checking account and one credit card for each property, or each company. And it's so much easier to handle now. It's so much easier. Like you said, you have like one statement. You could have the bank statement and the credit card statement, and you're done. Everything run through there. So amazing tip. So last tip.
Yeah, yeah, and I was gonna just to tack onto that one. You're probably leaving money on the table when you do it the other way, right? Because if you're unorganized, you're probably forgetting about things, and you can't
Mhm.
forget about it if it's going through one account. And then the last thing would be, just keep a great filing system. That's part of bookkeeping, right? So, the old, I'm old school, so I've got the box with the little green hanging folders, and each hanging folder has a little tag on it, and here's where my leases are, and here's my insurance, or whatever. You can do the exact same thing online with a scanner and whatever. I always tell people, I don't care how you do things, just the more organized you can be, the better off you're going to be. And the same thing for an accounting system. I don't care what accounting system you use. I don't care if you use QuickBooks or one of the specialized, real estate, Appfolio, Buildium, Stessa, whatever fits you, or you literally just, put it on a spreadsheet or put it on a piece of paper. Just make sure you're getting everything, and because you want to have a system that, one, you're comfortable with, and two, manages to capture all of the activity of the property.
Absolutely. Totally agree. Being able to find the stuff, right? Like, because if you have it all organized with your filing system, then you're going to be able to find, and it's going to be so much easier than just trying to locate it at the end of the year, all from one box that you are looking through. Uh, Absolutely.
Yeah, people always say, I don't have time to keep good records, right? Well, how much time do you spend looking for stuff when you don't have good records, right? Makes a
Yes,
difference.
yes. I implemented this year Dropbox, and you can do other ones. I just chose Dropbox because it's really easy to access files. And I just created the same structure for every property, and now it's so easy to find the stuff because I know that it's going to be on this file, on just this folder, and it has made everything really, really easy. And I'm going through the process of digitizing all my receipts, so I don't have the paper ones anymore. But I have one last question before we go. How long should we keep receipts and statements? My file cabinets are full, and I'm thinking, I don't think I need to have this for 7 years. Like, when can I start burning these things?
Right. So you want to keep tax returns, the actual tax returns, for 7 years.
7
You want to
years?
keep the records, the detailed stuff, for 3 years, right? So the easiest way to do that is, just when it's all said and done, let's say you use my box method, right? Well, it's all said and done after 3 years, you chuck the box, right? And shred it or whatever. If it's a digital filing system, you hit delete, right? Because you don't need it anymore, right? But keep the 7 years worth of tax returns. So 3 years of records, 7 years of tax.
So when you say the records, you mean like the statements and the bank statements and all of that, right? 3 years of that, but
all of if you're keeping invoices on things, all the detailed stuff. Yeah.
All right, awesome. So all my receipts from 3 years ago are going away next week.
Right. Yeah.
All right. Thank you so much for being here today and sharing so much information with my audience. If you are learning something today, please make sure to like and share this video and give us a good review. And for everybody that is listening and watching YouTube, Ted, where can they find you? And also, where can they get your books? Because I know you have more than one.
Yeah, right now the one that's for sale is actually you can buy the physical version on Amazon. I think it's $14.99 or something. It's insane. But you can also download it digitally on my website for free at www.lanzarocpa.com. That's the primary one. That's the most updated version, is on the website and on Amazon if you want the physical version. I can be reached via email at ted@lanzarocpa.com. That's LANZAROCPA.com. And my office number is 203-922-1742. But remember, if I'm working during those 2-hour blocks, I'm probably not answering, but I will call you back.
Right, so leave a message.
Leave a message, yeah, because I'll call you back.
Awesome, Ted. Thank you so much. It was a pleasure to have you.
Thank you. Thank you for having me. It was really a lot.
This was Real Estate Deal Closers with Anette Talie, brought to you by Talie Investments. We hope that you enjoyed this episode. Our goal is to provide amazing value on your real estate journey. Connect online at www.talieinvestments.com, where you can find this episode and more. Did you like this episode? Subscribe, like, and share.